When we're talking about external economies of scale, what we mean by that is that as a local industry grows, focusing on a particular industry, where often the firms are geographically clustered. This is not necessary, but it's often the case. So think of something like Silicon Valley, for example. Anyway, when a local industry grows, the average costs of production fall for all of the firms in that industry. So this is not to be confused with internal economies of scale. Internal economies of scale focuses on a particular firm, not on an industry as a whole. So what we're going to do from here on in is to illustrate the impact of external economies of scale using the standard demand-supply model. Again, we're assuming in a standard demand-supply model that we're dealing with a perfectly competitive market or industry. And of course, we know that that is not realistic. But the point is, in using it, is to illustrate an underlying idea. The first thing we'll do is to look at a situation where you don't have external economies of scale. That is, where we have something called constant returns to scale. So constant returns to scale means that as an industry grows larger, there's no impact on the prices of inputs. And so all the firms in that industry, as the industry goes larger, their average costs don't change. We'll start off here with equilibrium in the domestic market, and we're going to say this is the $30 is the break-even price. So at this equilibrium price, all the firms in this market are breaking even. So that no one's making supernormal profits or pure economic profit. Now let's say that there's an increase in the demand for this industry's product. Now, when that occurs, we will gravitate to a new equilibrium. Now, that new equilibrium point is above the break-even price. So it means that all the firms in this market will now be generating economic profit or supernormal profit. When that occurs, we know that in the long run, new firms will enter the market. So the supply curve will shift to the right. Now, the supply curve is going to shift to the right by precisely the same amount that demand has gone up by. So that the new equilibrium point after that is going to be here. And let's say that demand increases again. Firms now will be, again, operating above their break-even price. And because of that, new firms are attracted to the market, the supply curve shifts to the right, and therefore pushes the price, the equilibrium price, back down to break even. So we can say that in the long run, whenever we get changes in the demand for the product, we'll always end up, in the end, at the break-even price. This break-even price is the long-run price. So if we were to represent supply in the long run, it would be this horizontal red line. So we get an increase in output without any change in the price in the long run. Now let's look at external economies of scale. So in this case, there is, when the industry grows, there's a decrease in the prices of inputs into the production process. And so for all the firms in this industry, as the industry grows, average costs fall. So let's see how that works. We'll start off in the same way as we did before. There's an increase in the demand for this product. We gravitate to a new equilibrium that's above the original break-even price. This attracts new firms into the marketplace. However, when new firms come into the marketplace in this case, it generates external economies of scale, so that each firm has a fall in its costs of production. When that occurs, we then have the supply curve shifting to a far greater extent than the demand curve does. And so our new equilibrium, at which we have break even, is lower than it was before. So we can say that there's a decreasing break even price emerging. Let's say demand increases again. Now we move to another new equilibrium. This equilibrium point is above the new break-even price. So that means all the firms in this market are generating economic profit again, and this attracts new firms to the market. Costs of inputs fall, and so each firm's average costs fall. So the supply curve shifts to a greater extent than demand did. We now move to a new, lower break-even equilibrium point. So the break-even price has fallen further again. So if we look at each point which indicates the firms are breaking even, we can draw in our long-run supply curve, which now we can see, very interestingly, is downward sloping. As the industry increases size, the prices, the break-even prices fall. Now this is going to have interesting implications when we come to trade.